Welcome to the Delaware SBDC interview series, Considering Throwing in the Towel, Reflections for Small Businesses. If your business was adversely impacted and you are considering your options, this series of interviews will provide you with valuable information. In this first interview, we speak with Jordon Rosen and John Moll about how to assess your financial position, identify problems, make adjustments, and plan for the future.
Thank you for joining us for video one of our interview series. My name is Anthony George. I'm a business advisor at the Delaware Small Business Development Center. At the SBDC, we deliver training and free professional consulting services to help startups and existing small businesses formulate and execute strategies to grow and succeed. I'm developing this interview series to provide practical advice to small businesses adversely affected by the COVID-19 pandemic. I'm happy to introduce my two experts from Belfin, Lyons & Schumann, Jordon Rosen and Jonathan Moll. Jordon is a director in Belfin's Tax and Small Business Department, and Jonathan is a director in Belfin's Audit Department and heads their nonprofit group. Thank you both for joining us on today's interview. I want to start with our first question. Can one of you define what you would define as a distressed business?
It's a great question, Anthony. I think for whether or not you're a small business or a not-for-profit organization, the definition of distress is going to vary based upon the unique entity. However, ultimately, it's going to come down to, is an organization having difficulty meeting its financial obligations? When the creditors or its vendors are asking for payment, are they having difficulty paying it? I think that is the common theme for any distressed organization. Now, while cash is the ultimate indicator, liquidity is the ultimate indicator of what identifies a distressed organization, if you're not correlating yourself or identifying yourself as a distressed entity until you've already determined that you can't meet your financial obligations, you've definitely missed some warning signs along the road. I think it's important to know what metrics are important to measure as you're managing your organization. A lot of the metrics that are warning signs for a distressed entity would be some of your financial metrics, such as your quick ratio or your current ratio that measure liquidity, the age of your receivables, the turnover of your inventory. But it's important not to just look at those at a point in time. You have to really understand where you've been and where you are now to look at the trends to determine if those trends are going in the wrong direction. And that is really the warning sign of what could ultimately lead to problems with liquidity.
Okay, great. Thank you. So can one of you weigh in on some of the best ways that you would identify some underlying problems with the business?
Let me take a stab at that. I think the first thing a business owner needs to do, they shouldn't do it by themselves, is to put together the team. A multidisciplinary team approach is always best when working with a client. And what I mean by that is they probably want someone from the Small Business Development Center on their team. They want their CPA on the team. They want their attorney on the team, and most probably their banker on the team. Multiple set of eyes from different disciplines I think is always the best approach. This team needs to work with the small business owner in identifying what the problems are. You can't solve the problem until you've identified them. And I like to put those type of problems into three different silos. The first silo are those problems that I call are pandemic induced because of COVID-19. Great examples of pandemic induced problems is a break in the supply chain, definitely a pandemic induced problem. And the other problem is very obvious to a lot of small businesses that because of lockdowns, their employees can't come into their shop, into their restaurant, into their office to work. And because of other restrictions, customers aren't coming through the door. So you can have your employees there, but if no one's walking in the door, you have a problem. These are pandemic induced issues. So you have to identify those. The second thing they have to try to identify is whether there were problems that the small business was having prior to the pandemic. Examples of these: high employee turnover, problems with collections and accounts receivable, or not having a good business model. These are problems that they may have had already. So now if you've identified having these type of problems and you're now putting them on top of these pandemic-induced problems, that's a big nut to crack. And I think everyone has their work cut out for them. And it may be insurmountable, it may not. Hopefully something can be worked out. And the third silo that I like to talk about are those that were pre-pandemic type of problems, such as accounts receivable, that just become exacerbated because of the pandemic. And that's the perfect example. If your company is having cash flow problems collecting receivables before the pandemic, you're probably in a world of hurt because of the pandemic, because your customers are paying slower, you don't have as much business coming in the door, and this just causes a lot of problems. One of the things that the advisors, this multidisciplinary team of advisors, can help the small business owner identify is whether or not these problems are just for that business or whether they're industry-wide. I know John's going to talk, he's talked a little bit about metrics, and he's going to be talking about cash flow analysis. They need to identify, is it just this particular company, this business that is having the problem, or is it industry-wide? Is it systematic within the industry? And if so, they have other resources within the industry that they can usually turn to for more assistance.
Thank you. So when we talked more about the business model and putting together the team, what are some suggestions and the adjustments that the business owner could make in light of the current situation?
That's an excellent question. And taking the example of the business model, the industry that I like to use are restaurants, which we have a lot here, and a lot of those in Delaware. The business model, a good business model needs to be flexible. And if you look at the restaurant industry, the business model for a restaurant is strictly, for most restaurants, is dine in. That is their business model. So if that was their only business model prior to the pandemic, and now we have the pandemic and customers just aren't coming in the door, again, I use the term, they're going to be in a world of hurt, okay, because they weren't flexible. A flexible business model and those small businesses that had the foresight and invest in technology, invest in other methods to bring customers in the door or different ways to do business, would have invested in technology for takeout and delivery, using the restaurant model. These businesses, even though customers couldn't walk in the door for dine-in purposes, would be able to come and take advantage of takeout and home delivery food. So these small businesses may not be suffering. They're suffering, don't get me wrong, but they aren't doing it as bad as those that completely had to shut down because they had a stagnant business model. And for those that did have a stagnant business model prior to the pandemic, if they want to change over and now have delivery and takeout, they're scrambling. They had to scramble from day one, and it was just harder to implement it, and they were behind their colleagues that already had a flexible business model to start with.
Okay, thank you. Now for my next question. How can a small business owner better financially plan in the current environment? And what are some suggestions around financial planning that we could give to the small business owner?
That's a great question, Anthony. I think the financial plan, especially in this environment, it really is a detailed path to financial sustainability. The very first thing you need in order to be able to financially plan is ready access to real-time, accurate financial information, because during this process for a company that's in distress or entering the period of distress, there's going to be decisions that are made and difficult decisions. You have to have accurate, reliable, real-time information to make those decisions. Jordon talked about having a multidisciplinary team. That's going to consist of both your external experts, your advisors, but also the people in your organization that have boots on the ground that are responsible for developing and mining information out of your accounting system. And that's the very first thing that you need. People to rely on, people that are strategic partners internally and externally that provide you valuable information in order to make your decisions. You have to know the difference between accrual accounting and cash accounting. A lot of organizations prepare their financial statements on an accrual accounting basis, but when you're entering distress, cash is king, and you're going to want to know what your liquidity is. So if you do maintain your records on an accrual accounting, you'll definitely want to know how to convert that. What does that mean from a cash flow standpoint? Now, developing the forecast, I hear a lot of people use the 13-week forecast. That's sort of the model for organizations. 13 weeks is in theory one financial quarter, and they think that 13 weeks is the perfect period to develop a financial forecast because, one, it's short enough that your information is accurate and reliable. If you go too long, too far out into the future, you lose reliability because it is somewhat of there's many assumptions that go into building a forecast, but it's long enough that it's still, you can make strategic decisions that affect the organization out into the future. When you're building your forecast, a lot of people say you start with your expenses because you can control your expenses. I sort of take a little bit of a different approach. I think you should start with your revenues. You want to have a reasonable, realistic approach to forecasting your cash inflows from revenues. I don't want to be biased by what my expenses say I need my revenues to look like. I want to know what I honestly, realistically think we're going to collect in terms of revenues, and then build a cost structure, a model around that. Because the goal, again, is financial sustainability. Can I come to a place where I'm financially sustainable through this forecast? You want your forecast, once you build the baseline forecast, you want to maybe have multiple scenarios because no matter how great of a forecaster you are, the actual results in the future are not going to be identical to what your forecast is. So you want to build your forecast on what you think is most likely, and then potentially have a best case scenario or a more optimistic forecast and a maybe a more pessimistic or a worst case scenario forecast, because this is ultimately a tool that you're going to use to make decisions. You want to chart a path to financial sustainability, but you want to be nimble. So if during the course of operations you're charting closer to the more optimistic path, then you are already going to know what decisions you have to make based upon that forecast. If you're charting more towards the more pessimistic forecast, you know what decisions you'll have to make based upon that. And you're going to want to revisit the forecast regularly. Just because you do it once doesn't mean it doesn't get updated maybe on a weekly basis. And you want to consistently look at trends. How close were we on our forecasting to actuals? Because maybe there's a flaw in your methodology for forecasting. Ultimately, you have this tool where you identify a path to financial sustainability if one's there, and you definitely have to understand the difference between what short-term sustainability is as well as long-term sustainability, because you want to build a long-term sustainable business model, and sometimes you make decisions that put you out of or put you in negatives or out of sustainability short-term, but brings you into sustainability in the long term.
Okay, great. So let's say that we build a financial plan and we also evaluate the business model. We determine that we really can adjust, and we determine that the financial plan is not looking that good. I mean, let's say we projecting out persistent losses, negative cash flow. What are some options available to the business owner in that scenario?
I think for any entity, whether or not it's a small business or a not-for-profit entity, there's value in the business. A lot of times there are great businesses that maybe under a certain operating management team or an operating style aren't financially sustainable, but potentially under another operating style, it could be profitable and financially sustainable. So the first thing I would do is see if there's interest locally within the industry to potentially sell the business. I think that would be the first choice. Does somebody value your business at a level that is consistent with how you value it, that you could then sell the business? If not, then you reach out to your creditors, see if they're willing to renegotiate terms. Are there some alternative options to bring you into sustainability from a cash flow standpoint? Even reach out. There are economic disaster recovery loans that are available through SBA. See if there are other methods of capital that you can obtain through investing, financing, to maybe invest into your company and make the changes needed to determine sustainability. And if all else fails, then you could look at potentially bankruptcy as a solution for debt relief.
Okay, thank you. And also, can one or both of you touch on some of the lessons learned for the small business due to this pandemic?
You know, that's an interesting way to conclude. I think this pandemic has pushed many businesses, many industries 5 to 10 years into the future where they wouldn't be for 5 or 10 years, working remotely, rethinking, their office size and the amount of space that they occupy. So I think the main idea is that many of these businesses are going to have to operate differently. They're not going to be able to look at the old way of doing business. They're going to have to be thinking, what does this pandemic mean for the future of my business and for my industry? And, you know, when I do financial planning with individual business owners as individuals, of course, we always tell individuals that they should have 3 to 6 months of emergency cash equal to that's 3 to 6 months of expenses in case of a small business, operating expenses set aside. So the same 3 to 6 months, or it might be different depending on the industry or what cash flow normally is during the course of a year for that particular business, needs to be set aside. And they need to maybe small businesses, lesson learned, not take as large of a salary in the future so they can set aside some of the profits for a rainy day. You know, in accounting terms, we call it accumulated earnings and profits, retained earnings. Keep some cash aside so it's available for a rainy day. So if you weren't prepared for a pandemic or a similar situation, and you needed to react quickly, as we were talking in the past, you're not scrambling. You don't have to worry about borrowing as much money. You have the cash to invest in the technology or to whatever it takes to make the appropriate adjustments.
Yeah, Anthony, I'm a Jim Collins fan, Good to Great. I see a lot of clients and a lot of companies who are profitable, and because of that, they never really needed to rely on having that same day accurate financial information because the news was always good. And I think in these times, conditions can turn quickly. So if you're not for these organizations that are not in a state of distress, take the opportunity to see if you have your best practices in place. Do you have the right people on the bus? Do you have your team of advisors there that you can rely on to give you that real-time information to make decisions on? Because there are people and organizations making decisions now that they never thought they'd have to in the past, and it came on suddenly. So put yourself in a position to make those decisions now before you have to.
Hey, thank you. And that concludes the questions I have for today's interview. Thank you very much for your time today and giving us such valuable information. If you want to learn more about Delaware SBDC, please go to delawaresbdc.org. And also, if you want to learn more about our two experts, they can be reached at belfint.org, belfint.com. So thank you again for joining us today, and this concludes today's interview.
Thank you for watching. The Delaware SBDC provides one-on-one free and confidential business advising. Contact us and schedule a meeting today.